ASRN Nederland, ASRNL, trading as an American Depositary Receipt, ADR, under the ticker ARNE, represents a compelling investment opportunity. The company has successfully executed a transformative acquisition from ASR Nederland, cementing its role as the second largest insurer in the Netherlands. The investment case is driven by robust capital generation, demonstrated underwriting excellence, and a significant valuation discount relative to European peers. The analysis concludes that the market is currently undervaluing ASR Nederland, failing to fully price in the synergistic benefits and the resulting acceleration in earnings expected over the next 2 years. A. Price target. The 12-month price target is set at €64.00. This target reflects the high end of the current analyst consensus range, €61.63 to €64.38, and anticipates a narrowing of the price-to-book multiple gap as execution risk relating to the Aegon integration diminishes. Based on the last close price of €58.32, this target implies an upside potential of approximately 9.7%. B. Key investment drivers, KIDS. Synergy catalysis and integration success. The integration of Aegon Nederland is entering its final phase. Management is fully on track to deliver the crucial €215 million in run-rate cost synergies by 2026. This realization is expected to deliver substantial, non-cyclical accretion to earnings per share, EPS. Exceptional solvency and capital velocity. The Solvency II ratio stood at a highly robust 203% as of June 2025, significantly exceeding the management's target of safely above 160%. This financial strength, coupled with strong organic capital creation, OCC, funds a highly attractive and sustainable capital return program. Underwriting excellence. The core non-life operations exhibit strong technical performance, evidenced by a combined ratio, CR, of 91.9% in 2024. This level is below the targeted 92 to 94% range, confirming effective pricing power and sophisticated claims control even in an environment challenged by inflation. Attractive valuation gap. ASR Nederland trades at a favorable price-to-book (PB) ratio of 1.2x, representing a notable discount compared to the average of its specific peer group, 1.7x. This PB discount, coupled with an attractive forward PE of 10.54x, suggests a compelling entry point ahead of expected earnings acceleration. C. Principal risks, counterthesis. Integration and execution risk. The primary execution risk involves potential delays or shortfalls in fully realizing the ambitious $215 million synergy target. Integrating two large operations requires complex migration of IT platforms and careful management of personnel and culture. The specific breakdown of synergy sources, IT, personnel, is not publicly detailed. Regulatory political overhang. While the national pension transition offers significant growth opportunities, unforeseen changes or complexities in implementing the Dutch pension reform structure could delay or dampen the high growth target set for defined contribution (DC) inflows and associated pension buyouts. ADR liquidity. For U.S. investors specifically using the ARNNU ticker, liquidity risk is acute. The over-the-OTC traded security exhibits an extremely low average daily trading volume, 19,119 shares, which presents material execution challenges and market impact risks for institutional position sizing. 2. Strategic competitive landscape and market dynamics. A. Post-merger market dominance. The acquisition of Aegon Nederland has fundamentally reshaped ASR Nederland's competitive profile, solidifying its standing as the second-largest insurer in the Dutch market. The company maintains a balanced and diversified business mix with non-life insurance segments, including property, casualty, disability, and health accounting for 57% of revenues, and life insurance, including pensions, contributing the remaining 43%. Furthermore, ASR maintains market dominance in key niches, notably holding the market leadership position in the highly specialized disability segment measured by gross written premiums, GWP, with a reported market share of 30.6% in 2020. This diversification across mature, stable segments provides defensive characteristics against localized market volatility. C. Dutch sector context and resilience. The Dutch insurance sector is characterized by ongoing consolidation, reflecting a saturated non-life market and a life sector that has steadily contracted over the past 2 decades. ASR's acquisition of ASRNL is a decisive action to capitalize on this trend by increasing critical scale and operational efficiency. In this consolidating environment, increased scale is a vital competitive factor, effectively functioning as a defensive moat. Larger insurers, such as ASR, possess the capacity to execute substantial pension buyouts and leverage specialized, cost-efficient administration platforms. This operational scale allows them to compete aggressively on cost and technical pricing, thereby raising the effective barriers to entry for smaller, less efficient players. Regulatory oversight in the Netherlands is rigorous, with effective supervision provided by De Nederlandse Bank, DNB, and Autoriteit Financiële Markten. Dutch insurers maintain robust capital buffers, with solvency ratios typically stable around or above 170%, providing a significant cushion against market shocks. C. Focus on pension reform uplift. A key structural growth driver for ASR is the ongoing national transition in the Dutch pension system, moving from traditional defined benefit schemes, DB, to defined contribution, DC structures. ASR is strategically positioned to capture a large share of this new market flow. Management has quantified ambitious cumulative growth targets for the current plan period, targeting €8 billion in DC inflows and an equivalent €8 billion in pension buyouts, up to and including 2027. The successful fulfillment of these targets requires a highly efficient and scalable operational backbone. The integration strategy specifically emphasizes leveraging take-up-pace, scalable, and best-in-class administration platform. This focused investment in future-proof, cost-efficient infrastructure is essential for handling the anticipated complexity and high volume of transactional growth associated with the nationwide pension system overhaul. 3. ASR Nederland integration, synergy, capital efficiency, and execution. The fundamental premise of the investment thesis is the successful integration of ASR Nederland and the resultant step change in efficiency and capital utilization. A. Integration status and value drivers. The integration has progressed according to plan throughout 2024 and the first half of 2025, now entering its final phase. The primary financial objective remains the realization of €215 million in run-rate cost synergies by 2026. The financial benefits of this integration are already manifesting in operational reports, having contributed materially to strong financial results and the substantial increase in organic capital creation. While post-merger integration processes are inherently complex and susceptible to pitfalls, ASR has focused on mitigating operational risks. The proactive strategy includes providing a warm welcome to clients migrating from the Aegon portfolio. This emphasis on a seamless transition and customer retention demonstrates management's commitment to mitigating the operational and reputational risks associated with large-scale portfolio transfers. B. Capital efficiency through partial internal model. A critical component of the value creation strategy, extending beyond simple cost reduction, is the acceleration of the adoption of the partial internal model, PIM, across the combined group. The strategic intent behind PIM adoption is to optimize capital efficiency and improve the accuracy of risk model sensitivities for Solvency II reporting. By utilizing advanced internal models, ASR can optimize the calculation of its solvency capital requirement, SCR, compared to the standard solvency formula. This sophisticated approach to capital modeling reduces the regulatory capital burden required to support a given unit of risk, effectively freeing up surplus operational capital that can then be deployed for shareholder distributions, further M&A, or strategic reinvestment. This process represents a sophisticated method of maximizing capital velocity within the highly regulated insurance environment.
Governance, constraint, and capital alignment. ASR's operational autonomy is subject to certain structural constraints stemming from the transaction structure. Egon retained a 29.99% stake in ASR following the completion of the combination. This stake grants Egon special veto rights over specific material capital management decisions and significant changes to ASR's dividend policy. While the overhang of a large minority stake might introduce temporary market pressure should Egon execute a material divestment in the future, Egon has already initiated a share buyback program itself. The governance agreement ensures fundamental alignment. The retained veto power guarantees that Egon's interest remains aligned with maintaining stable capital management and a predictable dividend stream, which is beneficial for all long-term shareholders. 4. Financial performance and underwriting quality. The quality of ASR's earnings is exceptional, driven by scale, underwriting discipline, and a favorable operational leverage derived from the Egon integration. A. Profitability and operating return on equity. The operating result demonstrated sharp growth in 2024 and H1 2025, largely attributed to the contribution from Egon Nederland and improved performance across all established segments. Crucially, the operating return on equity, ROE, reached 14.4% in the first half of 2025, comfortably surpassing the medium-term strategic target of exceeding 12%. B. Non-life segment performance and inflation management. The underwriting performance in the non-life segment provides a robust indicator of operational superiority and pricing power. ASR targets a non-life combined ratio, excluding health, in the range of 92% to 94%. The company achieved a combined ratio of 91.9% in the full year 2024, improving by 1.7 percentage points from 93.5% in 2023. This achievement of a combined ratio below 92% is particularly significant when considering the broader macroeconomic environment. Inflation generally increases claims payments, the claims inflation effect, in the non-life sector. Achieving a lower combined ratio despite this underlying cost pressure confirms that ASR's strategic pricing measures and improved underwriting results are successfully outpacing inflation in claims and expenses. This consistency validates the strength of ASR's technical discipline and its capacity for active reserves and pricing management. Furthermore, ASR continues to hold market leadership in disability insurance, demonstrating continued technical excellence in this specialized segment. C. Resilience to macroeconomic volatility. ASR's balance sheet structure is strategically positioned to handle interest rate volatility, a key concern for insurance liabilities. The company's Solvency II ratio exhibits a positive sensitivity to shifts in interest rates, which is characteristic of highly effective asset liability management within the life segment. Sensitivity analysis shows that a parallel movement of 100 basis points in the interest rate curve increases the Solvency II ratio to 204%. This positive correlation provides a key structural safeguard for ASR's capital position in a rising rate environment, differentiating its risk profile as defensively structured against broader financial market shocks. Capital management. A. Solvency II capital framework. ASR Nederland operates with exceptionally strong capitalization.
The Solvency II ratio reached 203% in June 2025, a significant improvement from 176% at the end of 2023. This ratio positions the company with meaningful redundancy at the 99.99% confidence level, according to external rating agencies. The substantial increase in the Solvency II ratio has been driven by several key strategic and operational factors: robust organic capital creation, the capital effects of the disposal of the banking entity NAB, and capitalized cost synergies generated from the Egon merger. The capital ratio is so strong that it significantly exceeds both the regulatory minimum and the internal management target of remaining safely above 160. This substantial capital surplus creates a compelling mandate for active capital deployment. B. Shareholder Return Program. The excess capital capacity directly validates ASR's aggressive and well-defined shareholder return strategy. Progressive dividend and payout. The company maintains a progressive dividend policy targeting mid to high single-digit percentage growth, a commitment extended through 2026. The interim dividend for H1 2025 was increased by 9.5%. The current dividend yield is attractive at approximately 5.6%. Supported by strong organic capital creation, the TTM dividend payout ratio remains conservative at 56.63%, confirming the long-term sustainability and progressiveness of the dividend. Strategic share buybacks. In addition to dividends, ASR has committed to a total share buyback program of €525 million throughout the 2024-2026 plan period. Management has demonstrated opportunistic capital management by actively utilizing this capacity, notably repurchasing $105 million of its own shares during Egon's sell-down in September 2025. This combination of a high progressive dividend and a large committed buyback program results in an attractive total shareholder yield. Furthermore, utilizing buybacks to absorb large secondary market placements, such as the Egon sell-down, supports EPS accretion while also stabilizing the market price during periods of potential supply pressure. Valuation analysis and peer benchmarking. The valuation analysis indicates that ASR Nederland is currently trading at a discount relative to its peers and its internal growth trajectory, presenting a clear opportunity for multiple expansion. A. Relative valuation multiples. Comparison against relative diversified European insurance peers, including NN, AGS, HNR1, WUW, MUV2, reveals a favorable standing. Price to earnings, PE, the trailing 12 months ratio, TTM, is approximately 12.4x to 12.8x. This is generally in line with or slightly below the specified peer group average of 12.2x to 12.7x. However, the forward PE ratio drops significantly to 10.54x. This compression strongly suggests that analysts and the market anticipate material near-term earnings acceleration driven by the realization of merger synergies. Price to book, PB. ASRNL trades at a modest PB ratio of 1.2x to 1.22x. This valuation stands at a considerable discount when compared to the average PB of its immediate specific peer group, which averages 1.7x. When examining ASR through the lens of the PB row matrix, the low PB ratio, 1.2x, contrasts sharply with the superior operating row, 14.4%. This suggests that the market has not yet fully appreciated the stability and quality of the earnings generated by the combined entity, pointing toward a fundamental undervaluation relative to the inherent profitability of the business. B. Growth and discount closure potential. The stock's valuation relative to its expected growth rate reinforces the view of undervaluation. The PEG ratio is cited as low as 0.17x, which is significantly lower than the peer average of 0.53x. A low PEG ratio indicates that the market is trading the stock cheaply relative to its projected growth trajectory. ASR Nederland's historical mean PE over the last decade was 5.94x. While the current multiples are higher, reflecting long-term structural improvements and increasing capital efficiency, the primary catalyst for a near-term re-rating is the confirmed achievement of the 215 million synergy target. The expected step change in EPS acceleration and the robust capital return program should act to rapidly close the PB discount, driving the stock multiple closer to the peer average as the risk associated with successful integration is fully removed.
Considerations for U.S. ADR investors, ticker ARNNY. U.S. investors accessing ASR Nederland through the ADR structure must recognize and manage the unique constraints imposed by this trading mechanism. A. ADR structure and market venue. The ticker ARNNY refers to ASR Nederland NV's American Depositary Receipt. This is typically a Level 1 sponsored ADR, issued by a U.S. bank and traded exclusively on the U.S. over-the-counter OTC market. ADRs are designed to simplify foreign investment by allowing transactions, settlement, and holding in U.S. dollars. B. Critical assessment of liquidity risk. The primary constraint for the ARNNY ticker is severe liquidity risk. The average daily trading volume for ARNNY is reported to be extremely low, approximately 19.19K shares. This contrasts markedly with the primary listing on Euronext Amsterdam, ASRNL, where daily trading volume frequently exceeds 200K shares. This minimal liquidity on the OTC market leads to several operational inefficiencies. Institutional investors attempting to execute large block trades may encounter significant market impact, meaning their transactions push the price substantially. Furthermore, low volume contributes to wider bid-ask spreads, which effectively increases the transaction costs for the investor and erodes potential returns. Consequently, sophisticated investors requiring superior execution efficiency or larger position sizing should investigate direct access to the primary ASRNL listing on Euronext Amsterdam. C. Dividend mechanics and tax implications. Dividends for ARNNY holders are converted and paid in U.S. dollars. Investors should be aware that, as with other foreign securities, dividends paid may be subject to foreign tax withholding at rates governed by the prevailing tax treaty between the United States and the Netherlands. 8. Conclusion and investment outlook. ASR Nederland NV is fundamentally a high-quality insurer operating in a consolidating, well-regulated market. Following the successful integration of Aegon Nederland, the company has achieved a scale that drives both operational efficiency and dominant market position. Key metrics are strong. Underwriting performance is superb, 91.9% CR. Profitability exceeds targets, 14.4% ROE, and capital adequacy is redundant, 203% solvency ratio. This robust financial foundation supports one of the most attractive total capital return policies in the European sector, combining a progressive dividend with a significant share buyback program. The most compelling element of the investment thesis is the demonstrable disconnect between the company's intrinsic value and its current market valuation. The discount reflected in the PB multiple, 1.2x versus peer 1.7x, is not justified by the underlying financial quality or the expected earnings acceleration signaled by the low forward PE, 10.54x. Successful delivery of the 215 million synergy target by 2026 is the primary catalyst expected to eliminate this valuation gap, driving the stock price toward the consensus target of 64 euros. While execution risk remains until the merger is fully finalized, the structural momentum from pension reform and the operational safeguards provided by capital redundancy position ASR Nederland favorably. The principal caveat for U.S. investors remains the severe liquidity constraint of the ARNNY ADR, requiring careful consideration of trade execution strategy.